You're listening to Macro Sunday, hosted by Darius Dale. Welcome to the Macro Sunday podcast. My name is Darius Dale. I'm the founder and CEO of Steno Research. And each and every week, we provide you with the best independent takes on the global macro environment here in the Macro Sunday podcast. And this week, we are recording hot on the heels of a tremendous week for the US economy when it comes to the data releases. And I'm in good company this week in relation to that discussion. First of all, welcome to you, Emil Møller.
Cheers.
Head of research here at Steno Research. And then in 10 minutes' time, we will invite Darius Dale, one of the best US macro watchers out there, to join us for this discussion on why the US economy is doing so well.
Yeah.
I mean, it's even accelerating, it seems, Emil.
Yeah, it's baffling, isn't it?
Yeah.
It's really just surprising you at every turn. It's really tremendous.
It is. And towards the end of every podcast, we will discuss our own portfolio of investments. And a broad disclaimer to begin with, our trade ideas can be...
Sometimes maybe good, sometimes maybe shit.
And they've actually been sometimes maybe good this week.
Yeah. Oh, yeah, we have a really successful week.
We've actually had a strong year, despite a few hiccups.
Yeah.
We've even made money in the Chinese market.
Yeah, would you believe?
That happens rarely these days.
Yeah.
Emil, let's start with a brief discussion on the week that we've just been through in central banking. 2 times 25 basis points from the Fed and the ECB. Nothing to see there. It was basically as expected.
Yeah, it was quite
But
dull.
what do you make of the sort of similarities and differences between the communication from the two?
Oh, I was here on the back of the ECB meeting. I was a bit surprised that Lagarde was so... she took a really firm stance on we are not cutting, and she really emphasized it. And I think if you contrast her to Jerome Powell, he was much more open, I'm not committing to anything, I want to keep all options open, I'm not answering you in any, it was basically a waste of time, to put it as it is. And I think Lagarde sort of got the same task when she went in.
Yeah.
And then I think towards the end, I think perhaps it's reflective of what's going on in the ECB Council.
Yeah.
I think she has some doves she wants to smack a bit to the side. I think that's why she did it. That's sort of my main take here.
Sounds like a decent theory. And in relation to Madame Lagarde, I think it's almost exactly the 1-year anniversary of a very, very famous soundbite. So let's listen to Madame Lagarde a bit more than a year ago, talking about inflation.
And I would err on the side of not making a very long-term commitment because there is too much uncertainty. But equally, we need to very clearly indicate that we stand ready in both directions. Let me go right into this. I see an inflation profile which looks like a hump. So it does clearly increase.
Hump.
Yeah.
I don't even think that we have a Danish word for that, but it doesn't really matter anyway.
No.
But the point here is that a bit more than a year ago, Lagarde and the ECB basically told us in very firm words, inflation is a nothing burger.
Yeah.
And here we are a bit more than a year later with a council still very worried about sticky components of inflation.
Yeah.
When we watch various price surveys, live gauges of inflation in Europe from various online retailers, etc., I'm personally starting to convince myself that we will be back at the 2% target relatively soon.
Yeah.
So how do you see this inflation discussion in Europe going forward? I mean, is there a decent chance that the ECB will now sound as hilariously stupid on inflation, just in the other direction?
Yes. That's the short answer. I think they are aware how wrong they got things
Mm.
in the past, and that's why they keep repeating data dependent, which is basically just admitting to we haven't got a clue.
Mm.
So, and what is the implicit consequence of being data dependent? I mean,
Well,
you're conducting monetary policy through the rearview mirror,
yeah.
and you should be doing it on a forward-looking basis. So that's basically the recipe of making policy errors, isn't it?
Mm.
So I'm very much skeptical to that approach, but I think it's a turn they've taken out of desperation, basically. But I think it at least the risks of them looking even more foolish is very, very strong.
I'm starting to convince myself that this was the last hike from the European Central Bank,
Yeah.
despite market pricing still at least pondering whether September or October could be live meetings.
Yeah.
But I'm not as convinced about the Federal Reserve cycle.
No.
Do you share that sentiment?
Yeah. 100%. I mean, and I can back this. I mean, I've been saying for months basically that I think that the Fed will probably outhawk the ECB, even though market pricing wasn't having any of it. And I think I'm slowly just getting more confirmed in my view, to be honest. And I think there are a lot of different. I mean, even though that the ECB has only has a mandate for inflation targeting, they're clearly operating in a much more complex political world. Hence why Miss Lagarde is president of the ECB.
Yeah.
And I think when push comes to shove, they will have to adjust on other parameters. And I'm slowly getting the notion that it's going to be expensive to target headline inflation the way that they would ideally like to. And I think she will cave in when it really matters. Although I'm not announcing a big time recession coming in, but I think the labor market will start to loosen up in the Eurozone.
Yeah. A light recession is likely, at least.
Yeah.
And that's in sharp contrast to the US economy. So why don't we invite Darius Dale to join us for a discussion on the acceleration that we've seen lately in the US economy. There is no way about it.
Yeah.
And as per usual, we introduce our guest of the week with a piece of music. And given that Darius played as, I don't know whether he was quarterback.
No idea.
For Yale Bulldogs, why don't we play a small soundbite from the Bulldog Yale fight song from Night and Day?
Bulldog, wow, 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 Eli Yale. Bulldog, wow, 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 our team can never fail. When the sons of Eli break through the line.
It is now our great pleasure to introduce Darius Dale, founder of 42 Macro, to the Macro Sunday podcast, one of the absolute best macro watchers out there. It's great to see you, Darius.
Andreas, man, thanks for having me on. I really appreciate what you do, what you guys do at Strenght Research. Obviously, Macro Sunday, huge contribution to the community. So I just want to say thank you for all that you're doing as well.
Our pleasure, Darius. We are recording hot on the heels of the advanced Q2 report from the US economy, the GDP numbers, the core PCE numbers out. Darius, it almost looks like a Goldilocks scenario when we look at the data released from the US economy today. What do you make of the US economy at this juncture?
I don't make anything different of what we've been saying for almost a year, which is the U.S. economy is super resilient, and it's super resilient for a variety of fundamental factors, some that are kind of pandemic related, some that are not pandemic related. At the end of the day, I think this report just sort of really advances that theme further into the mind of the consensus narrative. And more importantly, I think it really calls into question, this sort of record net short positioning that we continue to see in U.S. equity. So we can pack any of that, but I think we believe it's really important for us to have a real credible discussion around the possibility of a soft landing here in the U.S. economy.
It almost seems like the US economy is accelerating here. A few months ago, most people were stuck in a discussion of how big a decline we should expect from the economy, right? And now we are accelerating. Why do you think we see these green shoots from the economy right now?
Yeah, so I mean, as I mentioned, there's a variety of sort of cyclical and structural factors and why the economy is sort of accelerating here. And you're right, it actually is accelerating. We saw real GDP in Q2 accelerate to 2.4% quarter over quarter annualized. We saw personal consumption expenditures tick down a little bit to 1.6%, but that was more than offset by investment, accelerating pretty markedly to 4.8%. We had a decent acceleration in exports as well, and also obviously the surprise to the downside and the price GDP deflator really supported a lot of these numbers and statistics. But it wasn't just the GDP numbers, right? This morning at 8:30, we got a trifecta of super positive news that really supported our resilient U.S. economy thing. We also got the durable goods and capex data this morning, very, very strong. If you look at durable goods, new orders on a 3-month annualized basis, that number was 32% on a plus 32%. If you look at core capital goods new orders, that number was plus 6% on a 3-month annualized basis. And then, of course, we got jobless claims, both continuing claims and initial jobless claims, surprise to the downside, further, kind of really supporting this sort of Goldilocks type feel that we're seeing in the data, not just today, but really over the past few months.
I think 3 or 4 months ago, I wrote an potentially eye-opening piece, if I should say it myself, on the Chinese economy and the reopening prospects. And given that the second largest economy in the world reopened late last year or early this year, I wrote that it could be a major surprise to everyone how big of a thing it was for the global economy. Do you think any of this positivity is linked to China, and what do you make of the Chinese case right here, Darius?
Yeah, so I would, I respectfully push back against that because in terms of how we're tracking the Chinese data, most of that data peaked in delta terms right around kind of 2 to 3, or sorry, right around the latter part of Q1, early part of Q2. It's actually been slowing really since April for the most part. And if you kind of look at all the major economies from an economic surprise perspective, China is actually the second worst economy in the world behind Europe, which is, very much flirting with recession, particularly in the core economies in the Eurozone. So, we do believe this resilience in the U.S. economy that we're observing is core and fundamental to the U.S. economic machine. I don't know if I can share charts or not, but I do. We do have a list of reasons why the U.S. economy has been resilient really since we authored the theme last summer, and why it's likely to continue to be resilient at least until we get into Q4, perhaps as late Q1 of next year, in terms of when a recession might commence.
I know that you now cast the U.S. economic momentum, Darius. So why don't you take us through some of the sort of key variables that you watch here?
Yeah, absolutely. So, let me share my screen here.
Mm.
Just want to share some slides from our latest monthly macro scouting report. We put this presentation out to our 242 macro clients every month, the beginning of every month, usually right after the jobless claims, or sorry, the jobs report.
Mm.
And so we'll talk about, kind of what are these factors, right? So number one, there's near record cash on household balance sheets. Number two, there's near record cash on corporate balance sheets. Number three, private sector income and wealth have outpaced inflation on a structural basis. Number four, we have limited credit cycle vulnerabilities. Number five, we have limited exposure to the volatile manufacturing sector here in the U.S. economy. Number six, we have long and variable lags. Number seven, we have Bidenomics. And number eight, we have labor hoarding. So I'm just going to quickly fly through all these. We can unpack them, individually if you like, but let me just show a few charts on this. So number one, in terms of cash on household balance sheets, household checkable deposits and currency up at 4.5 trillion. That number was at 1 trillion prior to the pandemic. It's right around 3% of total assets. You got to go back to the early 1970s, late 1960s to see a share of cash or checkable deposits as a percent of household total assets. So, consumers feel rich. Number two, we have record cash on corporate balance sheets at around $2 trillion. You got to go back to, I want to say mid 1960s to see the same share of checkable deposits on corporate balance sheets as a percent of their total assets. So corporates feel rich as well. Number three, as I mentioned, key measures of private sector income and wealth have outpaced inflation since the start of the pandemic. This is inflation here in the light blue line here. Pink line shows nominal employee compensation. The red line shows household net worth. Black line shows corporate assets or cash. So that's checkable deposits plus money market fund exposure. And then the blue line here shows checkable deposits and money market fund exposure for the household sector. So as you can see, it's pretty much everything's beating inflation on a more structural basis since the beginning of the pandemic. Number four, we've limited credit cycle vulnerabilities. We show private non-financial sector credit to GDP as a percent of GDP. We show the debt service ratio here. On a 5-year Z-score basis, we're actually negative on the credit to GDP statistic. Typically, what you see ahead of a recession is a +2 type sigma reading, which indicates, we're growing credit really fast relative to the business cycle. and it's typically indicative of capital misallocation. So that's why we have limited credit cycle vulnerabilities in this particular cycle. Number 5, as I mentioned, we have limited exposure to the volatile manufacturing sector. Manufacturing as a percent of total non-farm payrolls is 14%. As a percent of GDP, it's 18%. These numbers are well down from where they were previous decades. And the reason this matters is because manufacturing actually accounts on a median basis going all the way back to the 1940s in each of those red bars, those recessions, it accounts for 98% of the net job loss that we experience in recession. So obviously with less people working in manufacturing and less in GDP, it's just it's just not going to do the kind of damage to the broader economy that it historically has. Number 5, we mentioned, we talked about this yesterday in our Bureau Vision discussion, Andreas. We have long and variable lags. So when you look at the duration on corporate credit and corporate MBS, or sorry, corporate credit and MBS, indices, the duration is back at levels that are, historically consistent with a much higher level of R-star going all the way back to the late 70s and early 80s. If you look at the spread between between the yields on those indices and the coupons on those indices, these spreads are as high as we've seen them, since all the way back to 2008 in the instance of corporate credit. It's all the way back to the early 80s in the instance of mortgage-backed securities. So effectively, folks are basically, there's a stasis in terms of issuing new debt for corporates. There's a stasis in terms of taking out new mortgages and moving in the housing market. That's obviously slowing down the impact of monetary policy. Number 6, we got Bidenomics. So if you look at U.S. government gross investment, it's actually growing at 11.5% on a year-over-year basis, on a nominal basis. We have this record non-war, non-recession budget deficit here in the U.S. economy at minus 8.5%. And then lastly, number 8, we got labor hoarding. We still have this sort of, kind of decent gap between the trend line and the latest total size of the labor force. But we've obviously recovered the trend line in terms of gross domestic income. And so what that ultimately means is that there's a lot of demand in the economy for jobs, but there's just not as many people working in the economy. So that's obviously contributing to some resiliency in the labor market in terms of delaying the firing cycle relative to all the tightening that we've experienced.
Great summary, Darius. And none of this points to a short-term recession as far as I can hear. So, I mean, what do you make of the probability of a soft landing here? Is it still underpriced in the global investment community?
Yeah, I don't know if I wouldn't necessarily say underpriced because I'm not smart enough to figure that stuff out. But I will say that it's underpositioned for.
Yeah.
And when I say it's underpositioned for, we track aggregated U.S. equities positioning in the CFTC futures and options data across all the different equity instruments. And that number, and we track it on a non-commercial net length basis divided by total open interest. So aggregate it all up, divided by the total open interest across all those instruments. And what we find is that, at right around minus 7% net short, that number is still is only in the 13th percentile of all the historical readings we've seen in that time series since going back to like 1998. And so investors are very dug into the bearish narrative here. And the reality is, if there is going to be a soft landing in the economy, that positioning is extremely wrong, right? Like it might be very right at some point, if there's a soft landing in the economy, and ultimately you wind up with stickier inflation outcomes than what's currently priced in from an inflation trajectory standpoint. But to me, that's a secondary process. I think we are still very much in the process of the market, having to accept the fact that the U.S. economy was just not going to be as bearish as a lot of investors positioned for at the beginning of the year. We weren't one of those investors, but that's kind of step one. Number 2 is debating whether or not there's going to be a soft landing, and then if there is a soft landing, the third step, following that would be, okay, what actually happens to inflation in a soft landing? I don't think we're there yet.
Yeah. If we look at the current trends in markets and the price action that we've seen lately, we've seen a trajectory upwards in cyclical assets, commodities starting to move. We've seen parts of the cyclical equity space starting to move in conjunction with expectations of a short-term pickup in activity. But is it fair that markets start to move on the back of hopes of a, say, positive trend in manufacturing? Or would you watch the broader services sector as sort of the major signal for bullishness for U.S. equities here?
No, great question, man. You and I discussed that yesterday as well, and I think it's worth unpacking. Like you did some phenomenal work on that, so tip my cap to you as well. Which is, it's very clear that the market cycle, the stock market cycle, and risk assets obviously feed off the broader equity market, U.S. equities in particular. That cycle is very much correlated to the manufacturing cycle, particularly manufacturing PMIs. Why is that the case? And my hypothesis is that investors, we constantly looking for leading indicators to gain edge, to put positions on financial markets. And clearly, the manufacturing cycle has historically been the leading indicator for the broader economy, the broader corporate profit cycle. And so this is why I think we as investors keen on that, or really to take cues from that relative to the services sector, which is obviously a much larger portion of the economy, much larger portion of the stock market in terms of market cap, et cetera. And so, if you look at a couple of things that I think are very instructive on how how the manufacturing PMIs might actually rebound at the bare minimum for on a few months. Could be, who knows if it could be the bottom. If we're having a soft landing, it could very well be the bottom. But at the bare minimum, I'm not willing to commit to that view yet. But I am willing to commit to the view that, hey, we're probably going to see a cyclical bounce in the manufacturing PMI here in the U.S. over in the coming months, and it's for two reasons. One, it's clear that it's very clear that the U.S. consumer has legs in terms of its resiliency and its ability to continue spending. And the reason that matters is because inventory to sales, if you look at retail inventories in particular, relative to consumer spending on goods, their nominal spending on goods, that inventory to sales ratio is at only 1.5. That's well down from, levels that it historically has been at, in previous cycles. And number two, we also have the ISM new orders to inventory spread, the spread between those two PMIs. That number has bottomed in January and has been rallying since. And that number is typically about a 3 to 6 month lead relative to the headline ISM PMI, which suggests that we're probably on the precipice of a multi-month, rise bounce in the broader ISM manufacturing PMI. So to me, that's something that I don't think investors are, particularly, cued into. I think we've seen this move and broaden out from a cyclicality standpoint, from a dispersion perspective within the equity market, which is something we very much flagged for our clients back in May, and saying, hey, this is something that very, could trend. And it actually has started to trend, and it may start to broaden out from a narrative standpoint. But the reality is, it's all kind of tied to the same thing, which is the economy is accelerating transitorily. Inflation has gone down much faster than most investors expected, including us. We thought it would go down, but it certainly has gone down much faster than most investors expected. So that's obviously reflated, expectations for real economic growth. And that reflation expectation for real economic growth has really caused a broadening out of performance and leadership in the equity market. Ultimately, if we are right on the view that a recession is likely to commence in Q4 or as late Q1 of next year, we have this 6 month, with models that kind of project these 6 month intervals, and that's the interval with the highest probability of occurring, Q4 to Q1. But eventually the cyclical leadership is going to fade. But if the recession starts in March of 2024 and it's July of 2023, that's a long time. That's a lot of time and space for the market to really have to price in or really price out that bearish positioning relative to where we actually are in the business cycle, not relative to what people thought we were.
What do you make of? You said you mentioned recession probability. What do you think is the most likely source? That is, where would we see the weakness? If that
Yeah, the weakness in the recessions, to me, it's got to start with the corporate profit cycle. If the corporate profit cycle does not recover in line with where we typically see, in line with what's currently forecasted from a sales and earnings growth perspective, you look at the S&P, particular their constituents. There's like a hockey stick recovery starting in Q4 of this year. And then obviously the hockey stick continues on as far as the eye can see from a growth rate perspective into Q4 2024. Maybe AI is going to cause that. I'm not smart enough to know that. No. But the reality is, if that hockey stick recovery does not materialize, then what are corporates going to do? They're going to say, well, I got to right size my operating structure, to generate earnings in the future environment. So to me, if I'm worried about a recession, it actually, the highest probability of seeing corporates have an adverse response to these cyclical dynamics is Q4 and Q1, because that's exactly when they're expected to have to show this very aggressive recovery in their operating metrics. And the reality is, if they don't show that aggressive recovery, then it's going to be you're gone until they meet those numbers.
And on a second note, what do you make of, say, the divergence between big corporates and, say, small time businesses? You sort of pushed a bit on corporate profits in the big scale, but could it be that the weakness will actually really come out from smaller companies at first?
Yeah, no, definitely. And small companies, it sounds like small when you say it out loud, but the reality is they're a very meaningful share of the labor market.
Yeah.
I want to say about 50, a little bit over 50 or a little bit under 50% of total employment in the US are from small firms or from firms that the NFIB categorized as a small, which is basically any firm under 500 people. And as someone who runs a small business,
It would
that
be one
doesn't
of the
feel like
biggest
a small
businesses in Europe, right?
yeah, but that's definitely not small, but so
Mobility,
for the purposes of this discussion, we'll include those in small, and they're very much having a recession in their sales and profit growth. We can see this in the NFIB sub indices. We definitely in terms of the levels of those particular sub indices, we are already past levels that have historically been consistent with recession in terms of like a median threshold in terms of analyzing in that perspective. So it's clear that there's an issue with small business. But again, going back to this labor hoarding statistic, the one thing that should scare you as a bear from a recession probability standpoint, from a soft landing probability standpoint, to me is if the labor hoarding thing is real, right? Like if that's a real thing that is new and tangible, and it's hard to understand and get your fingers wrapped around from the perspective of an economist. But if it's a real thing, companies might just hoard labor throughout the whole downturn, right? Like, because think about it, if you spent the last few years like finding it really challenging to find and retain and train talent, the last thing you're going to want to do is like at the first sign of a cyclical slowdown is fire a bunch of people, because ultimately you're going to be in a poor position to grow your business on the other side of a cyclical slowdown. And everyone who thinks there is going to be a recession, with the exception of like the far left tail of the bears on Twitter, realizes that it's probably going to be a mild recession. And so if you think it's going to be a mild recession, why would you fire a bunch of people knowing that a mild recession is going to be shallow and it's probably going to be short-lived, right? Like, so to me, it's like, I think this labor hoarding thing is real. And I do want to share one more chart on this labor hoarding stuff, because I think it's, I don't know. The answer is I don't really know what the outcome is going to be as it relates to this particular aspect. But it's something, Andreas, I think you can agree that it's something we got to get our heads wrapped around as investors.
Yeah.
So let me take you to the bottom half of this chart, where we show labor demand, which is household survey employment plus JOLTS, and the total labor force. Right, like you can see that we take it to this panel. The shaded area chart just shows the spread between labor demand and labor supply. So labor supply obviously is the labor force. We peaked at around like 6 million in March of last year. We're currently at a little bit shy of 4 million there, and a lot of that has come out of the decline in JOLTS. We've continued to grow total employment there, and so if you think about this kind of like the labor, like this labor hoarding thing, like, if we just continue to see JOLTS go down and down and down and down, then what's likely to happen is that this spread is going to dissipate back towards zero. And if the spread dissipates back towards zero, then the blue line here, which is employment cost index on a year-over-year basis for the private sector, it's historically tracked this spread pretty closely since the advent of the time series back in 2000. And if both those numbers like basically do what the Fed wants, that is how you get a soft landing, right?
Yeah.
Like I'm not saying that's the highest probability outcome, but it certainly is something that could happen, and it certainly has been happening. So it's not a cardinal sin to extend the trend.
Darius, one of the questions that we get asked by our clients and other investors on a running basis right now is sort of the flip side to what you presented on the corporate balance sheet side and on the household balance sheet side, with corporates prolonging duration during the pandemic to levels that we haven't seen in decades. They've obviously sort of secured golden handcuffs, if you know what I mean, given that interest rates have been on the rise, and they don't really feel the heat from that, given that they've locked in the interest rates for a prolonged period of time. But the flip side of that equation is obviously the the banking system, or the creditors, right? So what do you make of the losses that we haven't really seen yet in the banking system as a consequence of this prolonged duration profile of corporate credit, for example?
No, that's an excellent question. I mean, I really don't know what to make of it, other than it just probably is going to take a lot longer,
Mm.
right? Like, I don't think it's particularly exciting to say like, oh, there's going to be a recession at some point in the future, right? I mean, we know that, like, those
Yeah.
red bars do show up.
Yeah.
But as it relates to managing risk, particularly over the next 3-6 months, I don't think any investor on the buy side has the job security to put on a 12+ month trade, in 2023, unless your name is Ken Griffin, Stevie Cohen. But even then, they don't trade with that kind of duration. So the reality is, if you're talking about something on a risk manageable time frame, like, I don't think that what you just said particularly matters, because we're going to talk about the credit cycle, in the latter part of the recession. right? Those credit write downs and ultimately all the provisioning that needs to come with that. That is a process that is still ahead of us. But again, as we're having this discussion right now, is that process ahead of us like 3 months ahead of us? Is it 6 months ahead of us? Is it 9 months ahead of us? Or is it probably a year and a half ahead of us based on everything we talked about in terms of the long and variable lags? I don't know. I have a view. We base our investment decision making on the highest probability outcomes, but the reality is the distribution is pretty flat.
I'll allow you to briefly touch upon how to trade this towards the end, Darius. I mean, given the current positioning from large institutions, and given your positive view, I'd say, on the U.S. economy relative to the consensus here, what's cheap? where do we find cheap assets to buy in this kind of environment?
Yeah, no, I mean, I've been doing this for almost 15 years now, and I don't think I've ever looked at valuation I mean, I've done statistical studies on it, but every time I do a statistical study on it, the conclusion is this doesn't matter on a risk manageable time horizon.
No.
Like, it definitely matters on like a 5 to 10 year time horizon. But again, if you're listening to me talk about anything, like it's nothing I say is going to really be that particularly impactful on a 5 to 10 year time horizon. The reality is nothing most of us says is particularly impactful on a 5 to 10 time horizon. Go find your favorite economist or your favorite strategist and look up what they were writing about 2023 and 2013.
Yeah.
You feel me? That should tell you, like, this job is hard and we need to be humble and Bayesian throughout this whole process, right? So in terms of how to, kind of think about trading this or positioning for this, to me, I still think the biggest risk in financial markets today is right tail risk in the U.S. equity market. Like, it's a particularly U.S. phenomenon, right? Because so many folks are benchmarked to the U.S. The U.S. just has this unusual or beautiful history of squeezing bears right up until the last moment. I'll throw some statistics at you to supplement that point. If you go back and you look at the 12 recessions that we've had in the post-war era, and you look at the relationship between the market cycle and the business cycle, what we find is that the equity market always squeezes very aggressively into the beginning of recession. If you look at the median performance of the S&P 500 in that year leading up to a recession, it's plus 16% on a median basis with an interquartile range of 14 to 20%. There are no non-double-digit values in that 12 sample, that 12 that 12 observation sample. If you think about this from okay, where are we in that process? Who knows? None of us has a crystal ball, but the reality is we do know that it typically squeezes faster towards the end of the process, right? Bears are literally getting tapped on the shoulder on the buy side. This is what's happening. It's a long history of this in the U.S. economy, in the U.S. equity market. The last 3 months of that performance is plus 9 on a median basis with an interquartile range of 5 to 11. And so more than half of that plus 16% median return comes in the last 3 months, right? Like, so to me, and that's not including the starting point of, 13th percentile positioning in the equity market, right? Like, to me, I think the right tail risk associated with the career risk on the buy side is pretty staggering and pretty great here. It's not fundamental. It's not something that, you can go and say, okay, this is happening, therefore. The reality is, it's just part of the game. And as investors, you got to understand the fundamentals, you got to understand the technicals, but you also have to understand the behavioral. And so many people dismiss the behavioral aspects of this because they either don't know or don't care. But the reality is, behavioral aspects of the market have been really the dominant driver of the market this year. It's all been about folks being wrong on the timing of recession. And as a function of folks being wrong on the time of recession, that positioning has gotten squeezed. If they were right on the timing recession, that positioning wouldn't have gotten squeezed. So, it is what it is.
Incentives matter. I think that is the main conclusion here, Darius. Thank you very much for being with us here at the Macro Sunday podcast. If our audience wants to find out more about 42 Macro and you, Darius, where do they find you?
I appreciate you, Andreas, man. So definitely check us out, 42macro.com. Much similar to your business model as well. We service all the large institutional asset managers, family offices, RAs, from a consulting standpoint. We publish we do make a point to sell our actual written research at very low prices so that, folks in our retail investors in our community, smaller RA investors in our community can actually access the content and afford it. But generally, if you're going to be talking to me, you obviously got to have some big bucks. And then come check us out on Twitter. 42 Macro Weather is my public account.
Thanks very much for joining us, Darius Dale. It is always a pleasure to talk to you, and what a great summary about the U.S. economy. I think it's safe to say that we still have positivity ahead of us. I at least agree with that view. So let's see.
It's a pleasure, Darius.
Appreciate you, man. You are on the small list of people, and it's not small for for any other reason aside from your caliber of your insights. You're on the small list of people. When I disagree with you, I do my work. I do my job harder to make sure that I gotta stay up a couple extra hours, or wake up a couple extra hours early if like you're on the other side of me, because I respect the caliber of your research, man. You're really good at what you do, and congrats to you, the growth of your firm.
Thanks very much, Darius. Thank you for joining us.
Appreciate you, man.
Back after the discussion with Darius Dale,
Yeah.
a guy with a lot of numbers prepared.
Oh yeah.
But you gotta love it. I mean,
Yeah. Oh, it was intriguing. Absolutely.
and he made a very compelling case for a short-term pickup in U.S. activity,
Yeah.
and sort of another postponement of the whole recession chatter.
Yeah.
So, Emil, it is now time to discuss what to do about it.
Yeah.
We had a brief discussion with Darius on how to trade this. As always, we're 100% transparent about these things.
Yeah.
It's Steno Research.
Absolutely.
And if we look at our own portfolio, tremendous performance this week. Heavily loaded towards US equities, thankfully.
Yeah.
Where do you see the most value in the US equity space right now, and why?
Well, it's in the commodity cyclical sensitive sectors, right? It's in materials, it's in energy, it's all the boomer sectors, if you like. I think that's where the risk reward is best, and that's where we've been positioned, and we've seen some decent returns thus far. So
yeah. The good old boomer trade is back. And speaking of boomers, I'm actually not sure. He might be old enough to not be a boomer. Mitch McConnell, member of U.S. Congress.
Yeah.
I simply have to play a soundbite from his press conference earlier this week.
Jesus, yeah.
Path to finishing the NDA this week has been good bipartisan cooperation and a string of
and there goes Mitch.
Yeah.
A complete freeze.
Oh yeah.
That's the only pause that we are certain of.
Yeah.
you might argue. Obviously, it's not funny that he's not feeling well, but I mean, we've been chasing Joe Biden week in and week out, so why don't we chase a Republican as well in this podcast? Speaking of boomers and boomer trades, Emil, what do you make of the commodity momentum right now? I mean, it seems like we have momentum both on the demand and the supply side, right?
I think so. I think, well, on a structural basis, commodity and extraction of raw materials is just underinvested, and usually that creates sort of like supply issues if you have like really hiccups in demand, and that sort of takes that's reflective in the prices, right? And I mean, if you've been invested in commodities for a longer span of time, past months, you've probably been underwater. But I think we've timed the entry here pretty well. And so full disclosure, we're long here.
Yeah, so we entered a few weeks back. And I mean, it's pretty obvious to most that the supply side is constrained and tight. But we lacked the confirmation from the demand side that the demand side would actually confirm the price action that the supply side would suggest that we see. And right now, I think the stars align. We have a weaker dollar.
Yes.
We have tight supply, as we've had for a year or so, or maybe even a couple of years now. But the demand side is picking up from a cyclical perspective, both due to what we've been discussing around the US economy, but maybe also from China, Emil. And I mean, you obviously watch the emerging markets on our behalf. We're long the Chinese real estate sector. Tremendous returns this week. We're back in green territory on that trade. So, I mean, Emil, what to make of the Politburo meeting earlier this week? Do we see signs of fiscal stimulus finally arriving from Beijing?
Well, I think the exact wording from one of the statements that I read was, and full disclosure, I do not speak Mandarin. I speak 5 languages. Mandarin is not among them. But they explicitly said that we prefer stepping up on rhetoric rather than actually providing fiscal stimulus at this point. But even still, markets picked up and expectations sort of caught prices surging up, right? So I think we're at a juncture where it's been trading so low in China, and momentum has been so downbeaten, and now anticipation is sort of fueling out into the market. So yeah, that's tailwinds for longs here
So
for sure.
the way I
Temporarily.
view this
Yeah.
trade in real estate in China is the following.
Yeah.
I mean, I think Chinese real estate investors have gotten used to receiving a middle finger on an ongoing basis
Oh,
from the
yes.
authorities.
Yeah.
That is no longer the case as of this week,
No.
if you ask me.
Yeah.
They've changed their rhetorical stance on speculation in Chinese real estate. And that is in itself an interesting signal, I'd say.
I think
Even though they will not support it with money,
Mm.
you will no longer be chased like a dog in
Yeah.
that market.
Yeah.
And that's at least the difference.
Yeah, and I think the underlying cause here is, which is really important to point out, the Chinese economy is sort of ongoing. Well, it's sort of suffering from what we call a balance sheet recession, right? So, homeowners, they are really reluctant to pick up any more debts and spending, because essentially they sort of fear for their asset side on the balance sheet, because housing is under siege, right?
Mm.
And I think now they are really committing to say we're gonna keep the housing sector up, and that's what markets are responding to in relation to that. But still, we could sort of like embark on the start of a trap here in case
Yeah.
that's they don't back it. So that's the risk right now. But I think the floor is sort of set. That's why I'm sort of I'm getting more comfortable with being long. Let me put it that way.
I'm happy to hear that, Emil. I think we will leave it at that
Yeah.
for this week's edition of the Macro Sunday.
Yeah.
Remember that this is just an appetizer to a load of material that we release on an ongoing basis at stenoresearch.com. We have a live portfolio in there with actual money backing it.
Yeah.
We have our data hub with a lot of quantitative tools for your asset allocation. And we have 20, 25 articles a week with hot takes on everything from China to Brazil to the US economy and, of course, Europe, where we are based. And with those words, I'd like to remind you that we have an exclusive offer for the listeners of this podcast. Macro30 is your coupon code to get a subscription with a 30% discount at stenoresearch.com. We will leave the link in the show notes. I think that means goodbye for this week. Remember, in full disclosure, that our trade advice may be
Sometimes maybe good, sometimes maybe shit.